If you're fortunate enough to have Social Security, pensions, rental income, or any other sort of fixed income source that covers all of your expenses in retirement, first and foremost, congratulations. You're in a great place to be, and I'm sure it took you a lot of hard work to get there. As a financial planner, I've worked with a few people in this situation who also have other traditional retirement savings that they've built up over their careers, and they're wondering how they should invest this money that they don't necessarily depend on. Should you take no risk because you don't need to? Should you take a higher level of risk because you can afford to? It all depends on your unique goals and situation, and this is a perfect example of why a personalized financial plan is so important to get the most out of your money. So in this video, I'm going to cover 3 things that you should consider when making that decision on how to invest your retirement nest egg that you don't necessarily rely on for income. Hey everyone, my name is Jake Skellhorn. I'm a certified financial planner, and I own Spark Wealth Advisors with my partner Chris, where we help people retire with confidence and clarity. If this is your first time here, be sure to subscribe and hit that notification bell to stay up to date on any future videos I post, and leave a comment below if you have any questions about this video. So before we get started, I fully understand that this video won't be for everyone, but for those people out there who are savers, who live frugally and have invested early and wisely throughout their careers, you may have what we know as a good problem to have. So with that said, having extra money saved for retirement doesn't necessarily mean you don't need a financial plan for it. So there's 3 things that come to mind when I think of people in this situation. Number 1 is ask yourself, do you want to spend more money? So beyond the Social Security or pension income that covers all of your month-to-month bills, is there anything else that you would want to spend more money on since you have that saved up? Whether it be traveling more in your go-go years of retirement, those first initial years where you had the health and the mental capacity to travel more and move around more. Whatever it might be, just really take some time to think about how that money can really bring you the most joy in life. Obviously, a lot of people out there don't just want to spend money for the sake of it. So really try to ask yourself what you could use that money for to bring you the most happiness in your retirement. So with that said, traditional retirement spending rules like the 4% rule suggest that you could spend about 4% of your portfolio balance at the beginning of retirement, adjusted for inflation, without a significant chance of running out of money. So if you have, let's say, $1 million saved up that you don't exactly need, if you invested that in a 50-50 portfolio, you could spend another $40,000 per year out of that portfolio. So really try to think about what you could spend that money on if you want to spend it, to bring you, the most fulfillment in your retirement. Other dynamic withdrawal strategies, such as income guardrails, which I'll cover in another video, allow you to spend more than 4%. So if you're willing to be flexible with your withdrawal rates in retirement based on how the markets are doing and how your portfolio is doing, you may even be able to spend more than 4%. Just know that you may have to take a temporary pay cut depending on how the markets in your portfolio is doing. Again, I'll do another video on that, but there's multiple ways to go about how much you can afford to spend from a portfolio in retirement without running out of money. Again, this may not apply to you in this situation since you don't necessarily need the money. It wouldn't be the end of the world if you did run out at some point since you have those fixed income sources. But again, something to consider, just understand how much you can afford to spend from your portfolio and what you would want to spend it on, if anything at all. So other ideas for that, if you're not someone who likes to travel a lot, or if you're further into retirement and maybe not as able-bodied anymore, think about giving to family or giving to the next generation while you're still here rather than leaving a legacy later on. So again, just really think about what is most important to you and what could bring you the most happiness right now. If you find that you don't want to spend more of your money just for the sake of it, ask yourself if you want to leave money to the next generation, whether it be a family member or grandkids. If you want to leave money to someone after you pass, then you may consider investing this money a little bit more aggressively. So a higher stock allocation, something like 80-20 or even 100% invested in equities and no bonds, because in the long run, this is generally going to give you a higher rate of return. It'll keep up with inflation more. And again, if the market does take a downturn, you're not relying on that money, so you don't need to take withdrawals when the market is down. So this is a second thing to ask yourself. If, again, you don't really want to spend more money just for the sake of it, consider how this could help future generations in your family, or even leaving this money to charity after you pass. So again, think about how old you are now, your life expectancy, and when the beneficiaries of your funds would need that money to determine how you should invest that in a more aggressive manner. If you do want to leave a legacy, you should also consider doing Roth conversions. If you have any money in pre-tax accounts and a family member inherits that money, they will have to distribute that money as ordinary income within 10 years, as long as it's not a spouse. So consider how that could affect them tax-wise. If your children or grandchildren are in a higher tax bracket than you, then it may make sense to do a Roth conversion where you're paying taxes on that money now and they won't have to pay any taxes on it later. So again, just another strategy to consider to minimize the overall tax bill that you or your family will have by inheriting that money. If you are charitably inclined, another thing to think about is qualified charitable distributions from IRAs. So if you have any pre-tax IRAs, you will start to have required minimum distributions that have to come out of those accounts at age 73 or 75, depending on how old you are now. So at age 70 and a half, you're able to start doing a QCD, which again is a qualified charitable distribution. You can take that money and you can donate it directly to a charity without you having to realize any taxes on it. So for 2024, you can do up to $105,000 per year directly from an IRA. Keep in mind, this can't be done from a 401k or a 403b, so it's specific to IRAs. This is another way that you can give money away while you're still alive without, again, having any additional tax implications. For any money that's not in an IRA but in a taxable brokerage account, you can consider a donor advised fund, which is an account specifically used for donating money to charities, where you can move the money into the account now and decide later where you want to donate the money to. But one of the unique strategies that are associated with a donor advised fund is that if you have any highly appreciated securities in a taxable brokerage account, so for example, let's say you've bought Apple stock for $10,000 and now it's worth $100,000, rather than selling that stock and paying the capital gains taxes on it and donating the cash, you can move that stock directly into a donor advised fund, not have to realize any taxes on that, and the charity will get that full $100,000 whenever you decide to donate it later. So just another strategy involved in taxable brokerage accounts as opposed to those retirement accounts. And the third thing to consider when deciding how to invest this retirement money that you may not necessarily rely on is any overlooked or unexpected expenses that may come up in retirement. So things like home repairs, I would always typically recommend setting aside a good portion of your savings in cash for easy access. If you need to put a new roof on your home, a new AC unit, or purchase a new vehicle in retirement, you want to, account for that and put it in a savings account where you'd have easy access to it, and it's not going to be invested in anything that may tie it up in the market for any period of time. Beyond that, make sure that you are considering long-term care expenses. So towards the end of your life, most of us will need long-term care. Definitely try to account for that in your plan. You may want to invest some money for this because the costs of this do increase over time with inflation. When it comes to long-term care expenses, if you are in the beginning years of your retirement, your 60s, and you don't plan to need that long-term care until, say, late 80s or 90s, you may want to consider investing some money to account for this. Costs will increase over the years, so by investing it, just like anything else, you want to make sure that you have enough when you do get to that age. And the last thing to note on this last topic is inflation. So your Social Security benefit, of course, does have a cost of living adjustment that will increase each year with inflation, but a lot of pensions do not. So if you are someone with a pension, you want to make sure that you're projecting out what your expenses will be in, say, 20, 30 years. And if your pension is still going to be enough to cover that if it does not have a cost of living adjustment. So if your pension does not have a COLA, then you definitely want to project out using some sort of financial planning software or calculator, or working with an advisor to see what your actual expenses will be 15, 20, 30 years from now, to make sure that your pension will still cover those expenses after inflation. So it's almost guaranteed that everything that you purchase this year is going to cost more next year and in the future. So if that is the case, then you want to take some of this extra money that you have and make sure that it's invested in a way that's going to keep up with inflation, whether it be in a balanced portfolio like a 60-40 portfolio, or again, something more aggressive if you're comfortable with that based on your risk tolerance. Also, make sure that you're accounting for any non-monthly expenses in retirement. I know a lot of us try to start with how much do you want to spend on a month-to-month basis based on just discretionary spending. But make sure you're accounting for things like once a year vacations. If you want to set a separate travel budget, we usually do that for our clients here. So we want to make sure that we're factoring into that long-term plan as well, and adjusting investments accordingly to make sure that that extra nest egg is going to support, again, your desired lifestyle. So other things may be like paying for a family member's wedding. Again, anything that you can think of that would be a one-off expense that is not going to be covered by your monthly expenses. You want to make sure that you're factoring that in and investing accordingly. Like I said in the beginning of this video, this is one of those things that's highly unique and personal to your situation, what your goals might be with that extra money to get the most out of your retirement. But hopefully it gave you a few ideas of how you can spend this money if you do have extra money saved up. And on this topic, I did make a video recently about 3 signs that you can stop saving for retirement so you don't run into this issue of having too much money saved up and you can possibly retire sooner. So if you enjoyed this video, be sure to subscribe, like, and share with a friend, and you can check out that other video now. Thanks for watching.